About 4 months ago, I started telling people that what the Fed was going to do was far more aggressive than the consensus believed, and that I thought that the RBA would follow what the Fed was doing, because what they thought they would do, well, they were going through the process of taking away the unusually high level of stimulus that they put in place during the pandemic. And I thought I'd got that pretty much worked out, but what I discovered last week is what the Fed intends to do now is even more severe than I thought that they intended. And I think I'm not the only person who's surprised by that. And I think what is happening right now is the market is coming to terms, and other people in the market who do my kind of job are coming to terms with what the Fed now actually intends to do, and what that's going to do to bond markets. Okay, so last week the Fed increased the Fed funds rate to 3.1%, which is 3% higher than they were at the beginning of the year. And they laid out in their summary of economic projections where they think that they're going to take rates between now and March next year. And in simple steps, what they intend to do is, although they didn't put it precisely, this is my layout of what they've said. My view is on November the 2nd, there'll be an additional 75-point rate hike to 395 basis points. That'll be followed on the 14th of December by a 50 basis point rate hike to 4.35%. And on February the 1st next year, there will be a 25 basis point rate hike to 4.6%. And at that time, they will hold their position, and they intend holding the position at least throughout next year. And what they say, and there's an interview this morning by Neil Kashkari, who's the we don't hear a lot of discussion about Neil Kashkari. He's a really interesting guy. He actually was the guy who put together the program for rescuing the bond market in the financial crisis. That's what he was doing in the Fed. Now he's the president of the Minnesota Fed. And what he was talking about in his interview was it's really important that they don't cut rates when they get it up to that level, because they need to be absolutely sure that inflation is falling before they cut rates. So they're going to take up rate. They're going to continue to put up rates aggressively. They'll stop doing it in February, but then they're going to keep rates at that higher level of 4.6%. Now, we think that the RBA will follow that process and will wind up with bonds. A cash rate in Australia between 435 basis points and 460 basis points. And the reason that I'm prepared to split that at the moment is because my Australian cash rate model is 4.45% right now, which is halfway between those two levels. So what's important, though, is not so much what that data is, but what that data does. And there's a whole bunch of things that are in bond models. Usually cash rates are really not that important, or the Fed funds rate aren't that important, because all the other variables are doing completely different things. And the other variables are things like core inflation or budget deficits or current account balances. All of those can have much bigger influences in a normal time to the bond market than what's happening in the Fed funds rate or what's happening in the cash rate. But this is not a normal time. In this time, what is happening is that the Fed is putting up rates at a far faster rate than in a normal time. And now, in that circumstance, which is a very, very unusual, in that circumstance, it really is what the Fed is doing, which is driving up bond yields. And where we get to at the end of a process of rising bond yields is you wind up with a flat yield curve. And the flat yield curve means that if the Fed funds rate is going to go up to 4.6%, then 10-year bond yields are going to go up to 4.6%. And if the Australian cash rate's going to go up to 4.6%, then Australian bonds are going to go up to they're going to go up certainly above 4%, and they're a touch above 4% today. And what's happening is, and what has just begun, is a very aggressive sell-off in the world bond market. Sterling 10-year bonds, sterling gilts, as they're called, or gilt-edged securities, have gone from a yield below 2% to above 4%. They have doubled in yield in around 60 days. Now, that's an extravagantly rapid sell-off. And that's really important because the UK is the centre of the world foreign exchange market. You know, that's where foreign exchange liquidity is. For bonds to sell off, that's pretty severe. And if you look at US treasuries, they've sold off aggressively. And if you look at German treasuries, they've sold off very aggressively. So I think that that's going to continue to generate shocks in equity markets as long as that sell-off in bonds continues. The good news, interestingly, though, is the Australian bond appears 10-year bond, even though we've gone up to 4%. We seem to be the only bond in the entirety of the G20 which hasn't made a new high in yield for the year. And I find that fascinating. And if I'm going to generate an explanation for why that's happening, the best explanation in the bond modelling, in the bond models, are that it is the fact, which is something that nobody talks about, is the fact that in the previous quarter, Australia had the largest current account surplus in the history of our country, ever. And so we are generating huge surpluses because of our exports, particularly of coal and LNG. So if there was one country in the world in which you wanted to be in this kind of aggressive world of bond sell-offs and currency crisis, this would be the one. But I would say that the market's going to stay pretty rough for the next few weeks until we get, or until such a time as the bond market adjusts to what the Fed has just said that it's going to do, which is much more aggressive than I thought it was going to say it was going to do a week ago.